The collapse of First Republic Bank, the nation's 14th largest bank, was a shocking event that sent shockwaves through the financial system and the economy. Here is how it happened. First Republic Bank was a regional bank based in San Francisco that specialized in serving wealthy clients, especially in California and New York. It offered high-end services such as private banking, wealth management, and trust services. It also had a large portfolio of long-term mortgage loans, mostly adjustable-rate mortgages, ARMs, that were popular among affluent borrowers who wanted to take advantage of low interest rates. However, when the Federal Reserve started to raise interest rates in 2022 to combat inflation, First Republic Bank faced a double whammy. Its interest expenses soared as it had to pay more to its depositors and creditors, while its interest income declined as its mortgage borrowers refinanced or defaulted on their loans. The bank's net interest margin, which measures the difference between what it earns on loans and what it pays on deposits, plummeted from 3.2% in 2021 to 0.8% in 2022. The bank's troubles worsened in March 2023 when two other regional banks that catered to the tech industry, Silicon Valley Bank and Signature Bank, collapsed due to losses on their crypto-related investments and a run on deposits. These failures triggered a panic among First Republic's customers, who feared that their money was not safe at the bank. Many of them withdrew their deposits or transferred them to other banks, especially those above the $250,000 limit set by the FDIC for insurance coverage. The bank tried to stem the outflow of deposits by raising its interest rates and selling some of its assets, but these measures were not enough to restore confidence. In mid-March, a consortium of 11 large banks, led by JP Chase, injected $30 billion of uninsured deposits into First Republic Bank as part of a government-backed rescue plan. However, this lifeline proved to be temporary, as the bank continued to bleed cash and lose customers. On April 24, 2023, the bank reported a dismal first-quarter earnings report, showing that it had lost 41% of its deposits in just 3 months. Its stock price plunged to an all-time low of $8 per share, down from $150 in early March. The bank also revealed that it had failed several regulatory tests and was under severe capital and liquidity stress. On May 1, 2023, federal regulators seized First Republic Bank and sold most of its business to JP Chase for $5 billion. The deal ensured that all of First Republic's customers would have access to their money and that most of its employees would keep their jobs. However, it also marked the end of an era for First Republic Bank, which had been founded in 1985 and had grown to become one of the most prestigious banks in the country. The collapse of First Republic Bank on May 1, 2023, was the second biggest bank failure in U.S. history after Washington Mutual in 2008. First Republic was a San Francisco-based lender that specialized in long-term mortgage loans to affluent clients. However, as interest rates rose rapidly over the past year, the bank suffered huge losses on its assets and faced a massive run on its deposits. To prevent a further crisis in the banking system, the U.S. government intervened and seized control of First Republic. The Federal Deposit Insurance Corporation, FDIC, a federal agency that insures bank deposits up to $250,000, took over the bank and appointed itself as the receiver. The FDIC then sold virtually all of First Republic's assets and deposits to JP Chase, the nation's largest bank, for a nominal fee. The deal was facilitated by a $50 billion financing package from the FDIC to JP Chase, which agreed to assume all of First Republic's $103.9 billion in deposits, including those that exceeded the insurance limit, and most of its $229.1 billion in assets. The FDIC said that the final cost to its deposit insurance fund would be about $13 billion. The sale of First Republic to JP Morgan Chase was hailed by President Joe Biden as a swift and decisive action to protect depositors and taxpayers, and to stabilize the financial system. He said that regulators had acted quickly to prevent a repeat of the 2008 financial crisis, when several major banks collapsed or were bailed out by the government. JP Morgan Chase CEO Jamie Dimon said that the acquisition of First Republic would benefit his company and its shareholders, as well as advance its wealth management strategy. He said that First Republic's 84 branches across 8 states would be converted into JP Morgan Wealth Management Centers over the next 18 months. He also said that buying First Republic's assets would help absorb some of the losses from the previous failures of Silicon Valley Bank and Signature Bank, which JP Morgan Chase had also acquired in March. The takeover of First Republic by JP Morgan Chase raised some concerns about the concentration of power and risk in the banking sector, as well as the role of the government in bailing out troubled banks. Some critics argued that the deal amounted to a bailout for JP Morgan Chase, which received $50 billion in financing from the FDIC as a condition of buying First Republic. They also questioned whether the deal would create moral hazard or encourage banks to take excessive risks knowing that they would be rescued by the government if they failed.